Hi, I'm Lucas Rogers and I'd like to welcome you along to the Rogers Property Group. Today I'm going to be talking about a really important subject, and that is what financial structures can we buy property in. It's very, very important to work this out prior to purchasing, because if you buy your property in one type of financial structure and want to change it at a later stage, it's not as easy as just signing new documents or anything like that. You can run into stamp duty charges, well, you'll definitely have that, and you can also run into capital gains tax charges as well. So it's very, very important that prior to contracting, you've worked out what entity that you're going to purchase the property in. Now, I can't stand here today and say to you, well, everybody should be investing through a trust or a company structure. That would be incorrect, because everybody's got their own background and their own details, and I don't know all those, so it would be wrong for me to say that. I'd need to sit down with you individually and discuss that to give you some advice around it. But what I am going to do today is this. I'm going to give you some of the pros and the cons of the major structures that people buy property in, and you might be able to apply that to your own set of circumstances and make your decision from there. But once again, if you'd like to get in contact with me, contact me through the office and I'd be happy to give you some advice around that. Let's get started. So the first one we can buy in is a trust structure. Second, we have a company. Thirdly, we have what we call, it's an SMSF, or a self-managed super fund. And finally, we have our own names. Okay, a trust structure. Let's go from the top. A trust structure. Why do people invest in a trust structure, and what is it? Well, a trust structure is a separate legal entity to us. It's like somebody owning the property on your behalf. On your behalf meaning that you don't actually own it, but you get all the benefits out of it. Okay, so you can get all the income, etc., out of that property. But the reason why people put it in a separate structure is because it gives them asset protection. Meaning if they were to get sued in their own personal names, the property's held in a different structure over here, totally different, then our property is going to be nice and safe, and our creditors can't get into that. So why doesn't everybody use a trust structure? Well, while a trust structure gives you excellent asset protection, from a taxation perspective, it's not always the best way to go. It's not the best way to go because of the fact that the negative gearing can't be passed out from the trust out to the beneficiaries. Now, what does this actually mean in layman's terms? Okay, it means that if you buy property in the name of a trust structure, it can potentially cost you 2 or 3 times what it would cost you out of your cash flow if you'd owned it in your own personal name. So it's not much more expensive to hold. Okay, so it's not always going to be the best structure for people. People that tend to use these are maybe doctors, people that are going to get sued and so on, people that need that added layer of asset protection. But for your own general person, many people don't actually need that. Okay, so that's a trust structure. Moving downwards from there, a company structure. Well, once again, a company structure is a little bit like a trust in the fact that it's a separate legal entity to yourself. People run their businesses through a company structure, and this can often be a downfall if they're running their business through the company structure and then they're also buying assets through that same structure. The reason being is, generally speaking, if you're going to get sued, it might be through your business. You've done something wrong, somebody's wants to chase you for some money, whatever it may be, and if your assets are held in the same structure, the same company that your business is running through, then you've lost all that asset protection that you set out to get. So certainly a company structure is not going to suit somebody who's on a buy and hold strategy. It may suit somebody who's on a property development type strategy, where they're buying, selling, but to remember, when you hold a property in a company structure, you also miss out on your 50% capital gains tax discount. So it's not going to suit everybody. Moving downwards from there, a self-managed super fund. Well, a self-managed super fund is a great structure to hold property in. And it's very important that you get some specific financial advice as to whether that's going to suit you or not. I'm going to be talking about the ability to be able to borrow through a self-managed super fund and some of the pros and cons for that. Now, self-managed super is a great way to hold property because of the fact that you have fantastic tax incentives from that. Everything is taxed within the fund only at 15%. And then when you reach your preservation age and you're ready to retire, then everything within that fund can also be tax free. So there's no income tax from that, and there's also no capital gains tax within that fund as well. So it's quite lucrative in that regard. Not only that, is the self-managed super fund is a great way to keep your assets protected because it's very much like a trust structure in the fact that you don't actually own the properties that are held within that fund, okay? They're held on your behalf. So it keeps them very, very safe. So a self-managed super fund is certainly something worth investigating, but as I said, you need to get some financial advice around that to make sure that you're eligible to be able to do that, and it's the right structure to hold it in for you. It does have some downfalls. It's quite expensive to set up because there's a number of different entities that you have to set up. You need to set up, first of all, the super fund, then you need to set up a trustee to manage that fund, okay? And that trustee is generally a company. Then there's a second lot of structure that you have to set up behind that, and that is a second trust, which is called a bare trust, with another corporate trustee to manage that. So there's 4 different entities that you need to set up, and this is the right way to do it. So they're expensive to set up, and then you need some advice around that. So that's one of the drawbacks about using a self-managed super fund. The other thing is for a lot of people as well, it's not the right structure because of the fact that there's no duplication ability through that fund. So you can't set up a loan within an asset within a super fund and draw equity out and use that to duplicate and build more property. But if you want any further information around that, as I said, speak to a financial consultant around that, or give our office a call and we can have a talk to you about that. Finally, buying property in your own personal name. Well, it's not really a different entity, but it's an entity that people buy property in effectively. It's a great way, and it's probably going to suit 95% of Australians to buy property in their own personal names. Why? Well, they don't really need the extra added asset protection of a super fund or a trust structure. It's probably not needed because they don't have a high likelihood of getting sued. And as well, buying property in your own name probably gives you the best tax incentives out of any financial structure there is. You're able to use the negative gearing, you get a 50% capital gains tax discount when you go and sell it, so it's a great way to hold property. But be very cautious. Where I see people falling down with buying property in their own name is when husbands and wives or partners buy property together. You don't necessarily need to buy the property 50-50. You can buy the property 90-10, 20, 80%, it doesn't really matter, okay? But it's important to look at who's got the highest taxable income and who's got the lowest taxable income and buying that in proportion to that. And remember, although you might be buying your property with your wife and you're buying it 50-50, it's not just a case of transferring another 10% into her name at a later stage. That will trigger capital gains tax implications and also stamp duty implications as well. So my advice to you is this: get advice prior to purchasing a property. Prior to contracting, you need to know exactly what entity that you're going to buy that property in, because at a later stage, it's going to cost you a hell of a lot to change things around. I really hope this video has been of assistance to you, and if you've got any other questions, please get in touch with the office, or if you have a video that you'd like me to cover, then please send me an email at the office. I look forward to chatting with you soon.